Imagine handing your hard-earned money to a prestigious Wall Street asset manager, someone with a Harvard MBA, a team of analysts, and a multi-million-dollar asset under management. You pay them hefty fees because they promise they can beat the market. Now, what if I told you that over a 15-year horizon, there is a 94% chance that a simple index fund completely beats them? It sounds like an exaggeration, right? But it's true. According to the S&P Indices Versus Active scorecard, or SPIVA, a research scorecard published by S&P Dow Jones Indices that objectively compares the performance of actively managed mutual funds against their appropriate benchmark indexes. You can verify these figures yourself by checking the SPIVA report, which I've linked in the description below. SPIVA data reveals a global failure of active management funds. Over 15 years, nearly 90% of U.S. large-cap funds lagged the S&P 500, while a mere 1.18% of Canadian managers beat their benchmark. This trend is universal, with underperformance rates hitting 80% in Brazil, 97% in Europe, 76% in Japan, and 87% in Australia. We are going to dive into the mathematical reality of why professionals fail, examine the stochastic models proving their underperformance, and eventually break down a 3 ETF strategy to optimize your 15-year horizon using low-cost ETFs. This reality, however, often clashes with the narratives published by financial magazines and fund brochures, which frequently flaunt titles like Top Performing Fund of 2025 or Market Beating Streaks. They make selecting a winning manager appear straightforward, but don't be misled. Short-term performance is statistically indistinguishable from random noise. Those winning funds aren't smarter than the market. They're simply lucky. Let's look at the actual data on performance persistence. If a manager gets lucky and ends up in the top 25% of all funds in a given year, can they stay in the top 25% in the next 15 years? The SPIVA persistence scorecard tracks this, and the results are hilarious. Out of all the active Canadian equity funds that were in the top quartile in 2022, only 2.3% managed to keep that top-tier status just 2 years later. And if you look back at the top quartile large-cap funds from 2020, how many of them do you think were still in the top quartile by 2024? Zero. This brings us to our next psychological checkpoint. If the absolute best managers in the world cannot maintain their position for even 4 years, why are you paying them to guess what happens over the next 15 years? The reason individual investors don't realize how bad the situation boils down to something called survivorship bias. When an active fund consistently underperforms and lags the market, the asset management firm doesn't just leave it there to embarrass them. They systematically merge it into a better fund or liquidate it entirely to erase the terrible track record from public databases. Over a 10-year period, about 2 out of 5 of all actively managed mutual funds are quietly closed or merged out of existence because of underperformance. When you look at the bottom half performers specifically, over 23% are wiped out within 5 years. This constant weeding out of failures leaves behind a survival pool of funds that artificially inflates the performance record of the industry. It's like a school erasing the grades of every student who fails and then bragging about their high average GPA. Even with this massive systemic cheating, the surviving funds still fail to beat a simple index over time. Besides, active managers often claim that certain market conditions give them an edge. For example, in 2024, active small-cap managers had a legendary year where only 29.7% underperformed the S&P Small-Cap 600. The industry threw a massive party, claiming this proved active stock picking works in less efficient markets. But it was a complete illusion. In 2024, the S&P 500 beat the S&P Small-Cap 600 by 16 percentage points, the largest gap between large and small caps in SPIVA history. Because active small-cap managers naturally hold a slight bias towards slightly larger companies than their narrow benchmark dictates, their outperformance wasn't due to brilliant stock picking at all. It was just a structural byproduct of holding larger stocks in a market completely dominated by large caps. The same problem happens with bond managers. For a short time in 2024, unstable interest rates helped 59% of these professional managers outperform their benchmarks. However, once the market stabilized in mid-2025, Most of those managers lost their edge. Soon after, 90% of standard bond funds and 86% of high-yield bond funds were once again failing to keep up with the market. This proves that active managers are often blindsided by sudden economic changes, whereas a simple index fund is designed to stay steady regardless of market shifts. It isn't just bad luck that many professional managers fail to beat the market. It's a mathematical certainty driven by high costs. Think of it this way. A simple index fund is very cheap to run, while an active fund charges significant fees for management and trading. Even a small fee, like 1.2% per year, adds up fast. Over 15 years, that fee can eat away over 20% of your total potential gains. Because of these costs, an active manager has to be incredibly lucky just to break even with a low-cost index fund, let alone beat it. It gets even harder when you consider that no manager can truly predict the future. Between the high fees they charge and the extra risks they take, their odds of beating the market over 15 years are very low. Even if a fund manages to stay in business that long, there's only about a 15% chance it will beat a simple index. When you also consider the 40% chance that the fund performs so poorly it gets shut down, your actual odds of picking a winner that lasts 15 years are only about 6.3%. In contrast, a simple low-cost index fund is statistically much more likely to come out ahead. There's another reason why picking individual stocks is difficult. Most of the stock market's growth is driven by just a tiny handful of superstar companies, like Apple or Nvidia. Most other businesses perform just okay, or even poorly. Because professional stock pickers usually bet on only a few companies at a time, they often miss out on these rare big winners. In contrast, a simple index fund automatically owns every company in the market. This guarantees that you will own those big winners and capture the growth that actually drives the market forward. It's clear now that you've been paying for investment performance that statistically simply isn't there. You don't need Wall Street professionals to outperform these funds. You just need to avoid their pitfalls. By moving to a low-cost, passive strategy, you can significantly tilt the odds in your favor. Here is the specific 3 ETF portfolio designed to capture that market growth. So how do we build a portfolio that takes complete advantage of these mathematical certainties? To do this, we can construct a globally diversified 3 ETF core portfolio using institutional-grade, low-cost Vanguard funds traded in Canadian dollars on the Toronto Stock Exchange, which eliminates the need for expensive foreign exchange conversion fees. Whether you are investing from Canada or the US, the underlying strategy is identical. I will detail the Canadian-listed funds first, but if you are stateside, I have the equivalent US-listed tickers ready for you at the end. First, we put 50% of your portfolio into the Vanguard S&P 500 Index ETF, ticker VFV. This fund serves as the foundation of your investment plan by tracking the 500 largest and most successful companies in the U.S. Because the U.S. market is so huge and well-tracked, it is incredibly difficult for professional fund managers to beat it, which is why 94% of them fail to do so over a 15-year period. By using VFV, you get a massive, time-tested investment for a tiny fee of just 0.09% per year, ensuring you keep more of your money working for you. Next, we put 20% of the portfolio into the Volatility Canada All-Cap Index ETF, VCN. This gives you a simple, low-cost way to own the entire Canadian stock market, including large companies like big banks and smaller, up-and-coming businesses. The Canadian market is heavily focused on financials, energy, and materials, which is why most active managers fail here. They try to guess which of these few sectors will win, but they usually get it wrong. VCN keeps it simple and cheap at just 0.06%. Finally, we round things out with a 30% allocation to the Vanguard FC Developed All-Cap ex North America Index ETF, VIU. Think of this as your everything else fund. It covers stocks in developed countries across Europe and the Asia-Pacific region. Active managers often claim they can pick winners in these international markets, but the data shows they almost always underperform. If you are investing from the US or prefer US-listed ETFs, you can achieve the exact same strategy using these three equivalents: VOO for US exposure, EWC for Canadian exposure, and VEA for developed international markets. These offer the same broad diversification with similar low-cost efficiency. When you blend this 50-30-20 allocation together, the weighted average management expense ratio of your entire global portfolio is just 0.126%, compared to the average active mutual fund charging around 1.2% inclusive of hidden transaction costs. You are starting every single year with a 1.07% structural advantage. Over 15 years, that fee gap alone saves you a fortune. The final part of this strategy is a simple, once-a-year checkup called rebalancing. Over time, some parts of your portfolio will grow faster than others, causing your percentages to get out of whack. By resetting your investments back to your original 50-30-20 target every year, you are essentially forced to sell high and buy low. This simple habit helps you lock in profits from winning stocks and buy more of the ones that are currently on sale. It's a proven way to boost your long-term returns and keep your risk low without ever having to guess what the market will do next. It sounds simple, and that's exactly the point. While expensive fund managers are trying to outsmart the market, you're just doing the math. This one annual step is all it takes to shift your status from a fee-paying victim to a disciplined investor who actually captures the market's growth. But remember, knowing the strategy is only step one. Sticking to it for 15 years is how you actually build wealth.
Disclaimer: this content is for educational purposes only and is not financial advice. Always consult a qualified professional and conduct your own research before making investment decisions.
If you want to build wealth safely and effectively, without letting Wall Street eat away at your returns, hit the subscribe button. Drop a comment below, letting me know if you prefer indexing or if you're still trying your luck picking stocks. Thanks for watching, and I'll see you in the next video.